and you stumble across that term debt yield. It's like, what even is that?
Yeah.
Like, everyone else seems to get it but me.
Right.
Well, that's what today's deep dive is all about. We're cracking the code on debt yield.
Absolutely. And it's a lot simpler than it might seem at first glance.
So by the time you finish listening, you'll be the one dropping debt yield knowledge in every real estate conversation you're in.
That's the goal. Think of this as your insider's guide to sounding brilliant in the world of property finance.
Okay, I'm ready to sound brilliant. So let's cut to the chase. What is debt yield in plain English?
Well, picture debt yield as this financial detective, right? It helps uncover those hidden risks and opportunities within a property.
Ooh, I like that. A financial detective.
Right.
Okay, so how does this detective actually work?
At its heart, it's a measure that lenders use to assess risk. So just imagine you're about to lend a big chunk of change for a property.
Big chunk, yeah. Millions, probably.
Exactly. You want to be confident that no matter what happens in the market, that property can generate enough income to cover the loan.
Makes sense. You don't want to be left holding the bag if the market tanks.
Exactly. And that's where debt yield comes in. It looks at the property's net operating income, or NOI for short.
Okay, NOI, that's the cash flow the property generates after operating expenses, right?
You got it. So we take that NOI and divide it by the total loan amount.
So if a property is bringing in, say, $2 million in net operating income each year, and it's got a $20 million loan on it.
You're already doing the math. You divide that $2 million NOI by the $20 million loan, and you get a debt yield of 10%.
10%, boom. So that's how we calculate it. But there's got to be more to it than just crunching the numbers, right?
You're right, context is key. Because while things like interest rates and property values can be all over the place, debt yield is beautifully stable.
It's like the calm in the middle of a real estate storm.
You got it. It gives lenders and savvy investors a clear picture of a property's ability to generate income, regardless of those market fluctuations.
So it's not just about lenders then. Even if I'm not the one giving out the loan, understanding debt yield can give me an edge as an investor.
Absolutely. Think of it like having X-ray vision into a property's financial health.
Okay, that's a pretty powerful tool to have in your arsenal.
Right. It helps you identify red flags, maybe negotiate a better deal, and make smarter decisions overall.
So even if I'm just starting to dip my toes into the real estate world, getting comfortable with this debt yield thing can give me a leg up.
100%. It's one of those fundamental concepts that can really transform how you approach real estate.
Okay, I'm sold. Debt yield, it's important.
Yeah.
But before we go any further, I've got to ask, what about all those other real estate acronyms I hear thrown around?
Like what?
You know, things like LTV and DSCR. They seem related to debt yield, but different somehow.
You're definitely onto something. They're all interconnected, giving you different pieces of the financial puzzle when you're evaluating a property.
A puzzle, okay. So let's start with LTV. What is that, and what's the connection to debt yield?
Okay, so LTV stands for loan-to-value ratio.
Right. Loan to value, I've heard that one before.
And it's pretty much what it sounds like, the loan amount divided by the property's appraised value.
Sounds straightforward enough.
It is on the surface, but here's the thing, property values, they can be all over the map.
Especially in a market like Chicago.
Right.
Things are constantly changing.
Exactly. And that's where LTV can get a little tricky, because it's tied directly to that potentially volatile property value.
So if the market dips, suddenly your LTV looks very different, even if nothing about the property's income has actually changed.
Exactly. Which is why lenders often prefer debt yield.
Because it's focused on that steadier ground of income.
You got it. Debt yield cuts through the noise and focuses on that property's ability to generate cash, regardless of whether the market is up, down, or sideways.
Got it. So that's debt yield versus LTV. Now, what about that other one, DSCR? What's that all about?
So DSCR stands for debt service coverage ratio.
Debt service coverage ratio, catchy.
Right. It looks at a property's cash flow, but specifically its ability to cover its debt payments, so both the principal and the interest.
Which, let's be real, that's what everyone really wants to know. Can this property actually pay for itself?
Exactly. And in this era of, shall we say, dynamic interest rates.
You mean interest rates going up, down, and all around?
Exactly. It can make those debt payments feel a little precarious. But this is where debt yield shines again, because it's laser focused on that relationship between income and the loan amount. Those interest rate roller coasters don't phase it.
Like debt yield is the one thing that's staying put in this crazy world of real estate finance.
You've got it.
Debt yield.
Yeah.
The one stable thing. I like it.
Ah,
But okay, let's bring this down to earth a bit. Let's say I'm here in Chicago, and I'm checking out a brand new multifamily building going up in the West Loop.
okay, great example. It's a hot area, lots of competition. So how can debt yield help us size up this property?
Yeah, exactly. Like, can this building cut it in this market?
Okay, so let's say our West Loop property is pulling in what? $1.5 million in net operating income each year.
Okay, $1.5 million in NOI. Got it.
And let's say the lender is willing to give a loan for, we'll say, $15 million.
15 million, big loan.
Right. So to calculate that debt yield, we're going to divide. Remember, it's NOI over loan amount.
Okay, so we take that $1.5 million NOI divided by the $15 million loan. That gives us, oh, look at that, a 10% debt yield.
10%, you got it. And that's not just a random number. In the Chicago market right now, that 10% often acts as kind of a benchmark.
Especially for these newer multifamily buildings, right?
You know it. But, and this is important, it's not one size fits all.
Oh, right, because Chicago's got everything high-rises downtown, those cool storefront places in Wicker Park. Debt yield expectations probably change depending on what kind of property we're talking about.
Yeah, you're exactly right. That 10% is a good general rule for Chicago, but that ideal debt yield can shift depending on the property type. Like, for example, those multifamily buildings we were talking about.
Yep.
They're often seen as less risky, especially in in-demand areas.
So if it's a safer bet for the lender, they might be okay with a slightly lower return, right?
You got it.
Yeah.
We might see lenders accepting a debt yield of, say, 8, maybe 9% for multifamily.
Okay, that makes sense. Lower risk, slightly lower debt yield.
Now, compare that to something like, say, a hotel.
Ooh, yeah, hotels, much riskier.
Right. Hotels can be much more vulnerable to changes in the economy. Or even something totally unpredictable, like,
Like a global pandemic that throws the whole travel industry into chaos.
exactly, nobody saw that coming. But lenders, they have to factor these kinds of risks into their calculations, right? So for hotels, don't be surprised if they're looking for a debt yield more like 12% or even higher.
To make up for that added risk.
Exactly. And this is why understanding those nuances is so key. If you know the typical debt yield ranges for different properties in specific markets like Chicago, it's a game changer, especially if you're an investor.
It's like you have this insider knowledge. You can quickly look at a property and get a sense of whether it's likely to attract good financing.
Exactly. You're not relying on gut feeling. You've got the data to back up your decisions.
Data-driven decisions. Okay, so far we've mainly been looking at it from the lender side of things. But what about me, the borrower?
Ah, good point.
I mean, it's easy to think of debt yield as this thing lenders use to size me up, but are there things that I can do as the borrower to make my debt yield look better?
I love that you're asking that because understanding debt yield isn't just about knowledge, it's about taking action. You can't control the market, right? But there are absolutely things you can do to potentially boost your debt yield.
Okay, tell me everything. What can I do to catch a lender's eye?
Well, remember, it always comes back to that relationship between your net operating income and the loan amount.
Right, NOI over loan amount, got it.
So one of the most direct ways to increase your debt yield is to increase your NOI. Make that property work for you.
Okay, sounds simple enough when you say it like that, but how do we actually do that? Where do we even start?
Well, it starts with having a really great property management team in place. A good team is going to make sure you're maximizing your rental income, minimizing vacancies, just keeping things running smoothly.
It's amazing how often that gets overlooked, but having good property management makes a world of difference.
100%. And beyond just good management, you can get creative about ways to bring in additional revenue.
Ooh, I like where this is going.
Right. So maybe there's an opportunity to add a parking garage because parking is limited in the city. Or maybe there's demand for amenities like a fitness center or a shared workspace.
Ooh, I love those ideas.
It's about finding those extra income streams. Now, on the flip side, let's talk expenses.
Oh, expenses. Always less fun than talking about making money.
Right. But seriously, tightening up your expenses, it can have a big impact.
So we're talking like negotiating better deals with suppliers, making the building more energy efficient to save on utility costs, that kind of thing.
You got it. And these things, they might seem small, but they add up.
Little changes leading to big results.
Exactly. Now, one more pro tip. Don't be afraid to shop around for financing.
Okay, good advice. Don't just go with the first lender you find.
Talk to multiple lenders, compare their debt yield expectations, and then don't be afraid to use a strong debt yield to negotiate.
Leverage that knowledge.
You got it. Knowledge is power, and in real estate, debt yield can be your superpower.
It's amazing how much one little metric can tell you about a property, right?
Yeah.
But real estate's always changing.
Always.
So what about the future? Any guesses about where debt yield is headed?
Well, it's always hard to predict the future, especially in finance.
Right.
But one thing's for sure, technology is going to play a huge role.
Okay, so how is technology shaking things up when it comes to debt yield?
Well, we're already seeing a lot more sophisticated algorithms out there
Algorithms, okay.
helping to assess risk and even predict how much income a property might generate down the line.
So instead of just looking at the financials from the past, these algorithms are like looking at foot traffic, the neighborhood, maybe even social media.
It's crazy, right?
That's wild.
And this is only the beginning. As technology gets more advanced, I'm talking artificial intelligence, machine learning, we could be looking at some seriously accurate debt yield assessments. Imagine knowing how a property is going to perform years from now.
That would be incredible. But technology is not the only factor here, right? What about regulations? Could they change how we use debt yield in the future?
Oh, absolutely. Regulations are always changing, and that has a big impact on how lenders are calculating and interpreting debt yield.
So you're saying we might see stricter rules for certain types of properties.
Exactly. Especially the riskier ones. Or maybe they'll change how net operating income is calculated.
So basically, you got to stay informed.
Always.
Well, that's a perfect note to start wrapping things up on. For our listeners who are excited to go out and put this debt yield knowledge to work, what's the main thing you want them to remember?
You know, if I could only pick one thing, it's to not underestimate how powerful this metric really is.
It's a game changer.
Seriously. No matter where you're at, whether you've got tons of experience or you're just getting started in commercial real estate, understanding debt yield gives you a huge advantage.
It's like having a superpower.
Totally. You can see what lenders are thinking, assess risk, negotiate better deals. It's a total game changer.
It's like you're speaking their language,
Yeah,
right?
exactly.
And that's what we love to do here at the Deep Dive, right? Break down these complicated financial topics and make them easy to understand, fun even.
Couldn't have said it better myself.
Well, there you have it. Our deep dive into the world of debt yield. We hope you enjoyed it and that you're feeling ready to tackle your next real estate challenge with confidence. And here's a little something to think about. The next time you see a property you're interested in, why not take a minute to actually calculate the debt yield?
I love that.
You don't even have to be planning to take out a loan. It's just a great way to see things from a different perspective.
It can really change how you view a deal.
Exactly. Well, that's it for us. Happy investing, everyone.